Hello, I'm Jason Kelly. Thank you for joining me. In this video, I'll show you a good system for managing your index funds for higher profit and lower stress. Index funds are catching on for their ability to beat active management with very low fees. In a January 20 story in the Financial Times called "The End of Active Investing" comes this summary. Over 10 years, 83% of active funds in the United States fail to match their chosen benchmarks. 40% stumble so badly that they are terminated before the 10-year period is completed, and 64% of funds drift away from their originally declared style of investing. Given this, no wonder that passive investing funds, index funds, now command a third of the U.S. investing market, and most projections have them getting up to about half that market within the next 5 to 10 years. So really catching on, the word is getting out. You can save money on fees and you can create a higher performance by just owning index funds, which just own an entire segment of the market without a human being in charge picking and choosing what to buy. This is hot, this is not, that kind of gut reaction stuff, which everybody in the business knows doesn't work. And now retail investors are figuring out that it doesn't work, and in major numbers. The problem is just switching to index funds doesn't get away from all the problems inherent with active management. Think about it. If the pros involved in picking and choosing stocks are wrong half the time and end up trailing the index performance-wise, why would you stand a better chance if you start trading around index funds the same way the pros trade around individual stocks? It's an interesting question, isn't it? And many people are experimenting with that in real terms, and they're blowing it badly. When you change to index funds, your fees drop way down, and your performance will go way up if you stop meddling. But people don't. The index fund industry has done so well that they've created all kinds of ETFs and mutual funds that target smaller and smaller segments of the market, or different segments, or farther flung segments. There's an index fund for everything now, which means you can still fall prey to this idea of you should own this sector now and avoid this sector. You should switch to that country now and avoid this country. You should dial down your technology ownership and dial up your staple ownership. You can get the same kind of emotionally jarring, indecision creating information when you're an active index fund investor, which is the absolute wrong thing to be. The whole point of switching to index funds is to benefit from their passive investing approach. You are not picking and choosing when to buy and sell and trying to judge from headlines what you should do. You're staying put, making very few moves along the way. So I submit that even if you have made the very wise choice of moving your portfolio from active management to index funds, you're still not done. You're avoiding another person's emotional mistakes, but have you controlled your emotional mistakes? Probably not. And you probably need a system, and that's where I come in. My Signal system uses only index funds. It uses only a stock fund and a bond fund. The stock fund creates growth and a lot of price movement. The bond fund provides a little bit of income, but mostly preserves capital for when there's a lower price in the stock market that you can buy, and when there's a high price that you sell and move the capital into the bond fund for preserving for another buying opportunity. This is a little bit of movement. It's not as passive as just owning a fund and leaving it, but almost nobody does that. This, in my experience, is the best combination of a little bit of involvement, just enough so you know you haven't abandoned your financial account, but not so much that you're meddling in a detrimental way like the active managers that are so soundly beaten by the index funds. This system I began describing just there, using just the two funds and reacting to their price changes, beats the market over time in most time frames, not all, but most time frames. More importantly, it controls your emotions to keep you on a solid path of growth in the market in index funds. So you're not making the mistakes and your money's not having mistakes made with it by an active manager somewhere. Now, my 3 Signal system plans are 3 SIG, which has a 3% quarterly growth target, 6 SIG, which has a 6%, and 9 SIG, which has a 9%. The 6 funds they use, 2 in each one, are IJR and BND in 3 SIG. That's the S&P Small Cap 600 and the Vanguard Bond Fund. MVV and SCHZ in 6 sig. That's the mid-cap market leveraged by 2x, so it goes up twice as much as the stock market and it goes down twice as much too, so it's more volatile. And then SCHZ is the Schwab Bond Fund. And then TQQQ and AGG. TQQQ is the NASDAQ 100 multiplied by 3, so it goes up and down even more than the 2x fund. And then AGG is iShares Bond. That's it. Those are the only index funds I use in these 3 different plans. And here is how the plan works. This chart is from my book, The 3% Signal. So it's showing the 3% signal in action, not the 6 or 9%, but the other ones work the same way. You can get an idea for the plan here. And remember, they're using only index funds. That big bold line in the middle that says the signal line is the pace of target growth. It's not the pace of growth of the portfolio, it's the signal line. It's what tells us whether to buy or sell and how much to buy or sell. Notice what's going on here. Along the bottom, we have different quarters, Q1, 2, 3, 4, and then the next year, Q1, 2, 3, 4, because this is a quarterly plan. On the left, you can see the balance of the account. The signal line is going at 3% per quarter. You can see its balance in those white balloons at the top of the chart, starting at $10,300 and progressing to the right to end at $13,048. That's a growth of 3% per quarter. In the front part, you see that the value of your fund is above the signal line. That shows a surplus. You have grown more than you were supposed to by the signal line in this plan, so you're supposed to sell this amount. And notice the distance above the signal line is the amount you sell. The signal tells you that amount you should sell from your stock fund and put in your safe bond fund. Conversely, farther to the right, you see the arrows telling you to buy this amount, and that's when the value of your stock fund has fallen below the signal line, showing you that you should buy and then showing you how much to buy. That's how it works. And it works without any emotion because you only check in on a quarterly basis and you're only reacting to price changes. That's it. The signal line remains in place. No headline, no prognostication can change it. So you're shielding yourself from making the emotional mistakes that have bedeviled active managers for all these years so that they lose to index funds. You're not making their same mistakes. You're very prudent and rational with this system, and you're using index funds. So if you have made the switch to index funds, I applaud you. But now you need to take the next step and start managing them in a wise way to prevent yourself from making those mistakes that have allowed index funds to be the best way to go. I hope you will choose my Signal system. To learn more about it, look around my website at jasonkelley.com or pick up a copy of the 3% Signal. If you'd like to get going on the plan and receive information from me every Sunday morning, please sign up for the Kelley Letter. I hope to see you on the list. And if you're already a Kelley Letter subscriber, thank you, and I will see you this Sunday. Thanks for watching.